As a trader, you're always told to just trade the price action. But have you ever wondered what that really means to the professional traders at proprietary trading firms? Well, our firm is full of these traders, and few are better at dissecting and explaining price action and how to enter and exit using that information more than our very own Justin Spiro. In this video, he'll break down his trades bar by bar and reveal the secrets to price action trading that you need to know. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
So we're going to do another bar by bar analysis. This one is for the week of April 24th. So right away, I want to jump into a trade from just this morning on Amazon. So you could see that after hours, Amazon reported, had this really nice spike up, but ended up giving it all back. And basically the catalyst was that in the first quarter of the year, they had 16% revenue growth with their cloud computing business, which is a huge part of their business, makes up most of their business. However, the growth rate slowed to only 11%. And that's not good because Microsoft reported, and basically they had posted a 31% growth in the first quarter, and then management expected them to expects a 26 to 27% growth in the second quarter. So basically, Microsoft is beating them with their cloud computing business. And Amazon is not doing as well as expected. So right away, when I come in this morning, figure out the catalyst, I could see this pre-market low, and I could see this pre-market resistance right around $109. And you could see this 111 is 2-day VWAP. So for those who don't know where your VWAP flattens out in the after hours, that's going to be your VWAP from the prior day, aka 2-day VWAP. My thought was this morning that it could have a pop into either the pre-market high or a pop into 111 and then fail. And then get back through the opening price, thus going red on the day. And I call that trade a back through open. Rarely do I trade the first 15 minutes of the day just because I like the opening range to set up and I like to have levels to work with. However, this back through open is a very strong trade on gap ups and gap downs. In this case, right off the open, we got a pop into that pre-market high. It failed. Now you do have the option to go short right when it fails from that pre-market high, and your stop would be high of day. But I like to wait for that back through open. And basically what happens is the stock goes red on the day, and anyone who bought this opening drive thinking that Amazon was going to bounce, they're all wrong. And as soon as it gets below that opening price of 107.73, I'm hitting it short. And when these trades work, they work really well. They just go. So if you find that you take a back through open and you get short and starts holding, that's not really what you want to see. And typically when that happens, I'll end up getting out of half or just lightening up on the position a little bit. But you can see it worked extremely well. It goes red, fails. Now bid starts stepping up at 106. There's a hold on the bid at 106 and you can see it holds it. And I'm lightening up my position. That's a pretty good move. We got a $1.70 move there. Then I want to see, can it trade to the pre-market low? That pre-market low that we have here at 105.32. So lightening up on about half of my position as the momentum slows. That's a very good rule of thumb for these back through open trades because basically what it is it's a momentum trade. So lightening up on about half of the position, and you can see that it just ends up failing, breaking below that pre-market low, and I'm covering into that move. So that's the back through open. Typically, you want to trade that on a stock that's gapping down and failing from a resistance off the open, and then getting back through the open, and then vice versa on a long setup. It works great both ways. If we just flip Amazon app upside down, you can see what that would look like on the long side. So you'd have that failure off the open and then rip right back above the opening price and you'd be getting long there. Really, really strong opening drive momentum trade there, back through open.
On that green bar, the first, like when you like in a moment, that minute that close green, and I mean you might be thinking, oh, is that the turn? Like, do you let the tape guide you to not to cover there, just to keep holding, even though there was a like maybe bullish sign there?
Well, I kind of have the thought that the news is pretty bad for the stock, but what I'm doing is before that spike even happens, I'm watching it hold 106. So it holds 106 for a good minute here, and then it holds it again. And that's not really like that. That's a signal for me that momentum is slowing down. And when momentum slows down on a trade like this, you really want to cover a big chunk of it. So in this case, I was covering 50%, but I'm going to give it some time because it just had a really big move, right? It went from 109.50 down to 106. So oftentimes it's going to need to consolidate for a little bit before it continues in the direction of the trend.
So will you cover the full position if you see another bar green that kind of push higher? Like, where will you cover your full position if that after that green candle, if it goes high a little bit more?
Yeah, that's a good question. So the stop for this trade, once it starts working, is the top of this candle. You would not want to see this reverse and get back above the candle that broke through the opening price. So I have a hard stop in there. And if I do cover 50%, I have a nice cushion locked in. And really, I'm only risking about 30 cents on the trade after that, a little less. So oftentimes what I'll do is I'll let that extra piece of the position, I'll give it a little more wiggle room. I'm not going to get scared out of it if we just pop, because what could often happen is we could just pop into the 9 EMA or VWAP and then fail again. Often when a stock is going to trend very strong in either direction, it's going to respect that 9 EMA. So if I have gains locked in, I'm not really going to get scared out. If you're in a position where the stock fails like it did, and then it starts reclaiming VWAP and holding VWAP, that should not happen. In this case, it would reclaim the EMAs, it would reclaim VWAP and start holding above. That's not what you want to see. And I would cut the position before it gets to that stop, save myself some money.
So for the original entry, is your stop high of day?
No, the back through open, it needs to work. As soon as it goes through the opening price, it should work. It should work right away. When these trades work really well, they're going to flush or they're going to rip higher.
And then I was going to say, does it matter for you? What is your time frame off the open? Because I know, like, obviously, like Jonathan and I usually like the 3-minute back through open. So that's when, like, you literally will have like your either like your first 2 bars are going to be continuation bars, and that 3rd-minute bar is going to be that reversal going back to the open price. So I was like, what is your time frame? Are you taking it in a minute or 2 minutes off the open, or are you saying, like, if it gets back to the open price, say at 9:35 or 9:36, are you still taking the trade the same, or is it going to be different off of that?
That's a really good question. So, the strongest moves are really in like the first 10 minutes of the day. I wouldn't take a back through open like after probably like 9:45 really.
Okay.
It's like
So you're still taking it if it like, 'cause I know, like, usually it's like, ideally when Jonathan and I look at it, like the 3-minute back through open has been one of the ones that plays out the most. And so usually it's like for us, like anything past that, that's kind of when it's like maybe, yes, still worth taking, but not as much size/risk overall.
Yeah, I totally agree with you. Just from my experience, I don't have like a set rule in place, but generally it works best like in the first 5 minutes of the day.
Okay. And then with the when you said with your first initial half lot out after, are you doing it based off of the tape slowing down, or are you doing it based off of like trailing at like a 2-minute bar high, or how are you going about that?
Yeah, so most of the time I'm just scaling out a half when the momentum slows. So like that bid just, that it totally looked different, right? It flushed through the opening price, just continued lower in a straight line, and then held a price. There was a bidder at a price. That's a sign for me to get out of half. But I do agree, and I agree with you that another strategy is to trail 2-minute bars. And I was actually going to go over that next. Another way to manage this position is you get the back through open. Your stop could be the high of this 2-minute bar. This bar opens, next bar opens, your stop is moved up there. The next bar opens, your stop is moved to the previous 2-minute candle's high. And you would follow that up, and you would be stopped out on this bar here.
That's what I was wondering, if it's like 50-50, like is that first half of the position, is it based on the tape or 2-minute bar, whichever?
It's definitely based on the tape.
And then the second half of that position, are you then trailing that one at the 2-minute bar high? Or are you waiting to see basically like say like, or maybe not the second half of the position, but say like an additional like a quarter of whatever's left after that half. So you would be out of 2/3 basically into that like 2-minute bar high, looking for like a trend for the rest for the remaining 25%.
Yeah, typically I'm going to scale out of most of it and get down to about 20% or even like 10%, and I'll leave that.
Okay.
I'll let that trade out. The next one I want to go over is AI. This is a trade that started on last Thursday, and I covered it on Monday, but I really want to talk about this because I think it is a really, really great technical setup. This was really interesting to me last Thursday. You could see that AI is basically just consolidating, and it's done a really good job holding this 2150. And then last Thursday, we got this really strong trend in the morning. And all the artificial intelligence names were strong. The market was strong. So it really looked like this was kind of just bouncing off that 2150 support and just, pushing higher all day. However, like after the morning around like 10:30, 10:40, you could see that a seller just stepped in and started selling this thing all day. And it really looked like liquidation to me, given how strong that downtrend was. And my idea was that longs that were buying into this because they said, hey, AI held that 2150 support. All the other AI names are strong today. There was probably a lot of buyers in here that got caught. So once we broke this low and we were kind of just consolidating down here below the opening range low, I decided to buy some $20 puts for the following Friday. So expiry would be today, the 28th. Basically with the idea that we wicked the top of the range, went red on the day, and we began giving it all back. My thought process was that momentum could come in from those longs hitting the bids, and we would break this 2050, and then we would end up breaking this recent low here at 2030. So for me, let me just say this. A lot of new traders and developing traders will shy away from options because they think it's complicated, but it's not. You don't need to do, you don't need to learn about, as a beginner, I should say, you don't need to learn about like delta hedging, iron condors, butterflies, credit spreads, all those little fancy terms that scare new traders away from trading options. You don't need to, you can make it simple is what I'm trying to say. So with that thesis, I decided to buy those $20 puts. And basically what I'm risking on that position is just the premium that I paid, and I accept that risk. So in this case, I bought like 20% of my daily stop worth of premium, and I was willing to risk that entire amount. You could see that it ended up closing right at that support, below that support, that 2150 support, and right back down to these recent lows here. Now the next day, keeping an eye on it, that day one low acts as resistance all day. So I'm sitting in that options position and it's working perfect and there's nothing for me to do. Now it breaks below, after it fails from that day one moves low. Resistance is that day one low, fails, rolls over, breaks that triple bottom here, rolls over. Now, For me, the trade is not over because I think there should be a significant momentum move lower. I'm not just looking for, a dollar move lower. I'm looking for kind of like a gap down or a strong move lower after it breaks this support level. So I'm holding on to it, and you can see that into the close, it kind of bounces, fails from that bottom of the range, and then closes near lows. So again, this is a higher time frame trade. There's nothing wrong with the trade setup. Everything is working according to plan. Everything looks perfect. Oftentimes what will happen, or maybe not so often, is you'll get lucky. Basically what happened was AI gapped down on a news catalyst that NVIDIA was cutting production of their AI chips, which is not good for any AI related names, especially speculative AI names that aren't really doing anything special with AI just yet. AI is more of a speculative name, and a lot of the low floats that are related to AI are as well. So you kind of just walk into that gap down on Monday. Off the open, we get an opening drive lower, and I'm getting out of about 3/4 of that position on this opening drive lower. Now I have a nice profit locked in, and I'm willing to hold the rest, right? Because these expire on Friday and it could go a lot lower. You can see it pushes up, fails into 19, gets back below VWAP, and kind of just starts trending lower. Now my target for this was the 200-day moving average, which was 1730. And as we're kind of coming into that level, after we make new lows and start rolling over 1760s, 1750s, that's close enough for me. And I'm covering that position. And then by the end of the day, I have a very small amount of contracts left. I'm getting out of the remainder of those. But I just really want to highlight what triggered this pattern for me. That strong trend in the morning on the 20th, and then that liquidation. It really looked like liquidation to me, like someone had a lot of it to sell and they didn't care what price they got out of. And, it just this candle engulfs this entire range. And that led me to believe that there was some launch trapped in there that would create the momentum for that move lower. And then sometimes you just get lucky and you walk into a catalyst.
What was your risk again? Because if you hit a bit low, were you risking on top of that day range or in the middle, maybe?
When I put the contracts on?
Yeah, when you put the contracts on, what was your trigger to get out if things go wrong?
Yeah, well, after a day like this move should really have follow through. I mean, this is such a strong trend. After it trended higher, gave back the whole thing in a straight line and then continued even lower. Now, if this stock were to reclaim this 2-day VWAP here and start holding above, that shouldn't happen. After a strong trend like this, the next day, the stock should really continue in the direction of that trend for a day 2 move lower. And if this were to just shake this move off and start holding back above 2-day VWAP, where the average buyer and seller is from the previous day, that would be a big check against me, and I would not want to see that. In that case, I would probably get out of most of the contracts. Now I want to review FRC, and I'm going to start this from the time it reported earnings, which was Monday after the close. Everyone knows what happened with Silicon Valley Bank and the whole bank contagion. And we're going to start this off from the earnings. And I know there's a lot of headlines. Maybe newer traders and retail traders a little bit confused. Every day there's a new headline and it's moving so much. So we're just kind of going to do like a day by day review of what's going on here. So FRC reported Monday after the close, and basically they beat estimates and reported revenue higher than expected. But really the big deal here is that they suspended their dividend, and bank deposits are down 40.8% quarter over quarter and 35.5% year over year. And that's what causes this move here. Coming into the next day, the 25th, Tuesday, there was a headline mid-afternoon that they are reportedly considering a sale of up to $100 billion in assets. That is not good because selling off assets can be seen as they're in more distress than investors think. And if the bank is in trouble and needs to raise cash quickly by selling off assets, that proves how unstable they are as a company. And that's what causes this move here. And it did offer a nice short. Unfortunately, I could not get in. But however, the next day in the morning, there's another catalyst. And that catalyst was reportedly advisors have lined up potential purchasers on new FRC stock, and that's not good for the stock. Someone is likely to buy FRC for pennies on the dollar. If another bank takes it over, they're going to buy it for pennies on the dollar. And that's what causes this move here. Now, we get another catalyst around 235, and that is that the FDIC would consider lowering the bank's ratings if a deal can't be reached, and that would limit FRC's access to borrow money from the Fed. So really, really bad. You know, the FDIC is responsible for monitoring and regulating banks, and this basically suggests that the bank is in serious trouble, and again, like probably more trouble than investors think. And if the bank's access to Fed borrowing is limited, it could make it more difficult for them to raise cash and just meet their debts and their financial obligations. This went limit down, limit down, limit down. And something that I really want to highlight is that you should never chase a second or third limit down. You should wait for a pop. And I know that from personal experience. A quick little backstory is Herbalife, HLF, I believe the stock is. You know, I had read that the company was a scam and there was a headline out. This is probably 2 or 3 years ago, maybe 3 years ago. It went limit down. It opened up, went limit down again. I had major FOMO and I hit that big second limit down. And guess what it did? It opened up higher and went limit up, and I got stuck in that. So I think a really good lesson with these limit downs is if you don't get in on the first one, wait for a pop and a turn and get in on the second one, because now you have a lower high to risk against. You never want to chase a second or a third limit down, especially if they're far apart from one another. Sure, there will be some exceptions, like if a company announces that they cure cancer, I would buy like a third limit up, that's fine. But in most cases, you do not want to chase those. And it did, it offered a chance to get in. It popped, went limit up. I saw LRP flashing on this, hit in, and then again, you know, it holds this $5 level and I'm covering. So really nice 40-cent trade there. And now you have a clear level to risk against, which is this 580 high.
Do you have any kind of like rules of thumb on if you're already short or long in a position and it goes into an LRP on how to like exit that? Like, should you, if you're saying like don't chase the second or third one, then would a sell rule for that be kind of like get out of most of the position after the first one? Or like, are you looking for something like specific to exit? Or
so you're saying if you're already in a position and then it goes, if you're long, it goes limit up, or if you're short, it goes limit down.
yes. So like you're in the money and then it opens, like how do you manage the trade after that?
You want to ride that wave as long as you possibly can. And really what it comes down to is your tape reading skills and identifying held bids and held offers. So again, it's like a momentum trade. Like we discussed that Amazon trade where that bidder stepped in at 106 and I was covering half of the position. Same thing, you're riding that momentum. And if that momentum slows, you want to start scaling out. Another good rule of thumb is, so say you get in on this limit down, on this second bar here, your stop is going to be a high that bar. That should not retrace. It should do exactly what it did, which is gap lower and then move straight down again. So if you're getting in on a limit, a good rule of thumb is to put your stop at the high of that bar. And then again, you could trail the bars as a way to manage the position. Yep, so look, it goes limit down again. Now your stop becomes the high of this bar, which is 570. And now we're going to review today's move. So yesterday was pretty quiet for FRC. Coming into today, there was another catalyst, another breaking news catalyst that hit. So the headline came out, and the headline was, the focus seems to be on an FDIC solution that will involve receivership. So banks are being asked for their best bids, still hoping for a market-based solution, not a government solution, but still that is feeling less likely to happen. So basically, receivership is a process where a failed bank is taken over by the FDIC and its assets are sold off to repay debts. So that's not good. Banks are being asked for their best bids. Again, if JP Morgan's bidding for this, it's going to be for pennies on the dollar. And the fact that a market-based solution is less likely, it could suggest that there's really no other options available for the bank, and there's not going to be a market-based solution. So you could see immediately it went limit down, held this like 476, and this 476 is actually the recent low. This recent low from Wednesday, and now it's breaking to 52-week lows. What we have is a higher time frame breakdown, essentially. Now, again, don't want to just chase this and get excited. Want to wait for a pop and a turn to short against. So on this bar here, I see LRP flashing on the bid. I get in short, and my risk is the high of this candle. It opens, goes limit down. Now we're breaking that recent low. And of course, we're breaking it on volume. Limit down, limit down. It opens, and you see the bids just stacked at 4. It opens at 4 and immediately lifts. It holds there for maybe 2 seconds max. And then it lifts right off 4, and you see those bids just stacked at $4. That's a sign for me to get out of about 75% of the position, and I could leave a stop at break even on the rest. Again, it holds 4, dips a little bit below 4. Actually, this one limit up. So it holds 4, see those bids stacked, lifts off 4, and pushes towards limit up. I'm getting out. Again, just leaving a quarter position on with a stop at break even. Pushes up, fails. On this failure, I'm getting back in short, and the stop is the high of this bar. Breaks below 4. I'm holding it. It goes limit down, opens, goes limit down again, opens, goes limit down again. And then same happens, except this time it's holding 3. It just touches $3. You can see the low of this candle is $3, and same thing happens that happens at $4. Those bids are stacked there. And as soon as it holds, I wish I had a clip of this, but what this looks like on the level 2 on the bid side is completely different from what we've seen this entire move lower. The bids are stacked, and that could be someone covering their position, or it could be a buyer at 3. But either way, when you see that $3 lift, you're basically taking the same approach as you did here, and you're getting out of the position. And again, I'm just leaving a quarter of the position on, just in case the stock halts and this ends up being a 0.
Justin, when you got back in on the second short and you moved your stop to the high of that candle, did you move it for the entire position, or are you still keeping the 25% at break even from the original one?
Yeah, now that it's breaking $4, I'm adjusting the stop for the entire position. And look, even if you didn't catch any of this, what I want to highlight is that a new trade sets up because you have that 473, you have that higher time frame recent low to work with. So that just becomes a higher time frame breakdown. And once it gets below, you could take that short. That's a very valid trade. Another very valid trade, even if you didn't get in on this move here, you recognize that bid at 4. Okay, the bids are really strong at $4. Again, just gets a tiny bit below 4 here, trades down to 397, lifts, you have another trade here. Okay, well now I know if the bid's decrement and it gets below 4, that's another trade setup for me. And that's exactly what happens. You just see those bids start decrementing. Goes from a few thousand, 3,000, NICE, ARCA, EDGX, tons of size on the bid, and you'll just see that drop lower and lower and lower and lower as people are hitting the bids. And as soon as it's about to drop out, you want to hit that for that momentum move lower and that $4 whole number breakdown. So you don't have to get in right away. Other trades will set up. You don't have to have FOMO and chase this move. If you chase this move, you're likely going to get stopped out here. Higher time frame breakdown, whole number holds, bids decrement, that's another short for momentum. And then again, same thing happens at $3, that happens at 4. Those bids stack, and it's just holding 3, holding 3, holding 3. That's a sign to cover your short.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.